The Fed rate hike, what they're really not telling you. You remember how Jerome Powell and all the government officials were like, inflation is transitory. I know y'all remember that, right? Well, they're not saying that anymore. Yeah, you may have heard already that the Fed is supposedly going all out against inflation and just announced another interest rate hike that would take the US interest rate all the way back to the dot-com bubble era. But let me tell you guys the real headline. They are not done raising interest rates. Here, check out what Jerome Powell said in the last one.
A couple times in your opening remarks, talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time.
So basically, he's saying that they really don't have a plan except for just to wait and see. Now, for the details of this rate hike, I mean, the move wasn't exactly a surprise for the financial markets. The Federal Open Market Committee, that is the FOMC, that is the committee that decides the rate hikes. Well, they raised the funds rate by another 1/4 percentage point, so they're in a target range of between 5.25 and 5.5%. And so this puts us at the highest level since early 2001. Now, the real big question on everybody's mind is whether or not this is going to be the last rate hike before the Federal Reserve takes a break to assess the impact of previous increases on the economy. Now, the odds for more hikes this year have been changing. Now, some experts are expecting a pause, but I personally think that they're going to be going all in on this one. I remember them mentioning in the June meeting how they slated like 2 more hikes before the year is out. But what do you guys think? Could the American people handle another rate hike? Keep in mind, prices on everything from Costco to Walmart, everyday items, food, gas, these items are not getting any cheaper, even still. Now, basically, Fed Chair Jerome Powell, he voiced the Fed's stance that there's still a long way to go from the Fed's 2% target rate. And like you guys heard in the clip, he said that he's keeping an open mind about the next meeting in September and that decisions will be made very carefully, analyzing incoming data. And of course, they're meeting for economic activity and inflation. Markets initially reacted with some bounce back after the meeting, but ended up pretty much mixed, with the Dow Jones Industrial Average closing higher and the S&P 500 and NASDAQ Composite little changed. Treasury yields saw a little bit of a decline. Now, here's something that's very interesting. On a hopeful note, and despite expectations of a mild recession, the Fed statement upgraded economic growth from modest to moderate at the June meeting. Inflation remains elevated and job gains are described as robust. It definitely already feels like we're already in a recession, but let's stick close to this one, guys. More updates to come for sure. But make sure you guys are subscribed to the channel and make sure you got that notification bell turned on. And hey, thank you for always hitting the like button, guys. I appreciate that. I don't know. Sometimes my friend and I, we talk about inflation and we get to the point where, the best way to fight inflation is to dismantle this corrupt political and financial system and everything that's involved in it. But maybe that's taking it a bit too far. But still, there's something to be said about how the Federal Reserve should pressure the government to cut its spending drastically to tame inflation versus these other strategies that are clearly not working. I mean, maybe they should do that instead. Cut spending. That would be a huge help. Stop sending our money overseas. What do y'all think? Now, after the 2-day meeting, the Federal Reserve issued a statement saying that the decision on future policy firming, i.e. interest rates, will depend on a lot of different factors like inflation, economic and financial developments, and other relevant aspects that they can think of. Basically, all to bring inflation down to their target of 2%. And so the question is, will the Federal Reserve raise interest rates again? It certainly looks that way. In fact, analysts from Barclays are suggesting that another rate hike is likely to happen in either September or November. I mean, you could see it in the wording of that recent statement. So it definitely points toward the likelihood of further rate increases. I mean, when you compare it to the previous statement, I think it's obvious. Jerome Powell, he talked about the importance of balancing supply and demand to prevent another surge in consumer prices. Now, for Americans and businesses, this means another rise in borrowing costs as rates for credit cards, adjustable rate mortgages, auto loans, and other loans, they're expected to climb once again. But on the positive side of the game, Americans, especially seniors, are finally enjoying higher bank savings yields after years of low returns. I mean, heck, even treasuries crossed over 5%. All in all, the path of interest rates remains uncertain, and the Federal Reserve will be closely looking at these economic indicators to make an informed decision for the next one. But seriously though, how is the economy in the United States right now? As economists are pointing out, a still resilient economy and stock market will probably persuade the Fed to raise interest rates once more. The government's expected to report that the economy grew a fairly solid 1.8% in the second quarter, surprisingly faster than what most forecasters predicted earlier this year. Last month, employers added 209,000 jobs and the average wages grew like 4.4% annually. And this is a slowdown from the previous months before the numbers were actually growing. Initial jobless claims, basically gauging layoffs, have gone back to historically low levels after rising in June. Consumer spending and retail sales both seem to have gone up. Plus, the S&P 500 stock market index, it's been climbing steadily since March. So consumer sentiment and spending, they're feeling pretty upbeat. But you know what they say, what goes up must come to a recession. The resilient economy seems to be persuading Fed officials that the inflation could be tamed without triggering a recession. But that's how overconfidence can get you. Y'all know what I mean, right? Powell and Fed staffers, they're no longer predicting a downturn. You see what I mean? Now, right now, they're looking at two key spokes on the economy: price stability and maximum employment. And those are the main considerations in this interest rate decision. But here's something that loan rejection rates on the rise. The rejection rate for people applying for credit jumped to 21.8% in June. This is the highest level in 5 years, guys. This is the rejection rates for credit cards, for credit limit increase requests, for mortgages, for car loans, and mortgage refinance applications. They rose to 21.5, 30.7, 13.2, and 20.8% respectively. Major banks have reported setting aside more money to cover bad consumer loans as credit card balances rise. Gotta watch that. Makes me think that the banks in the United States are in far more trouble than what we're led to believe. Now, that could possibly be the only real reason that they're not continuing to push interest rates up, as apparently that's the only thing that they can think of doing. I think some people have been trying to pay down their debt quickly, but at this point, they're feeling super defeated. They've also been trying to avoid bankruptcy, but they're not seeing too many other options anymore. But hey, they're still trying to stay positive though. The Fed's meeting schedule is as follows: July 25th through the 26th, September 19th through the 20th, October 31st and November 1st, and December 12th and the 13th. So if you notice, the largest gap between meetings is the one before September. Lots of data for the Fed to take in before their next rate hike decision. So hopefully they'll see what they need to see in order to calm down with those interest rate hikes. Now, about those credit cards, like I mentioned in our previous videos, the interest rates banks charge on our credit cards, they're pegged to the prime rate, which is largely connected to the federal funds rate. Now, in the late 70s and early 80s, state laws largely barred credit card lenders from charging more than 18%. In the mid-1990s, with the prime rate hovering between 8 and 9%, credit card rates, they were 15.5, 16%. But now, with the prime rate having risen to 8.25%, the average interest rate for new credit cards has risen from 14.6 in February of 2022 to 24.2% last week. Now, this has raised monthly interest charges to $140, roughly a $55 monthly uptick on the average American's $7,000 credit card balance. Now, as for stocks, the stock market has been surging on hopes that inflation is slowing enough that this last rate hike will be the last from the Fed this year, and that the economy will avoid a recession, especially since the labor market's so strong. Now, the benchmark broad market S&P 500 index closed at the highest level since April 2022, with the blue chip Dow having a winning streak of 12 consecutive days. This is the longest rally since February 2017. But still, some are worried because higher rates make borrowing and business investment more expensive. This also put a damper on consumer spending, which also shaves off corporate profits, and this could spark layoffs. Some economists are saying that a ripple effect could still occur, even though most likely towards the end of the year. They say that the recession risk is still elevated, pushed out, but not quite eliminated. The Fed's rapid rate hikes have definitely punched consumers in the pocketbook. Because of the 500 basis points in rate increases from March 2022 to May 2023, borrowers already will pay $34.4 billion in extra interest charges over the next 12 months. So now this new 25 basis point increase, it's going to cost consumers $1.72 billion more. And so this means that the annual cost of the Fed's recent rate bumps is a staggering $36 billion in total. Now, at the end of March, total household debt stood at $17 trillion. And the share of debt becoming delinquent rose for most debt types. And that was in March. So just imagine where those numbers are now with this latest rate hike. And about that Powell statement, economists are now saying that it was about as clear as mud. They basically don't want to declare victory too soon. They know inflation moves in fits and starts. The Fed's decision comes as inflation dropped to 3% year over year in June after hitting the highest levels in decades at over 9% in mid-2022. The Fed paused their interest rate hikes in June, but this month they're back at it, raising interest rates for the 11th time in the past 12 meetings. Basically, core inflation is stubbornly high and progress has been slow. Good news for savings accounts, high yield savings accounts, and CDs. So higher interest rates mean that many banks are likely to raise rates on their savings and their money market accounts. But rates may not have as much further to rise, meaning you can finally earn more than inflation on cash investments, and that's probably not going to be changing too much anytime soon. Now, if you really want to maximize those interest rates, you could definitely consider online banks or the top credit unions. They usually offer rates that are much better than those offered by traditional banks. Why? Because they don't really have a lot of those overhead related fees like locations, buildings, and all that stuff. Also, now is a good time to lock in multi-year CDs as some of these maturities are most susceptible to pull back once the Fed sees inflation start to cool down. Now, if you've already locked in a 30-year fixed rate mortgage in 2021, maybe 2022, you are in luck. You guys are set. But for the rest of us looking for access to new credit, it's a little bit of a squeeze to say the least. Whether you need credit cards, student loans, personal loans, auto loans, or anything else. By the way, if you own a home, make sure your home is protected. Get your free home warranty quote. There's a link in the description down below of this video. Now get this, guys. The average interest rate on a personal loan right now is a whopping 11.16% annual percentage rate as of July 19th. Yeah, guys, you heard that right. Plus, this last rate hike's probably going to be adding even more to these rates even more. Back in 2021, the average rate was just 9.38% APR when the Fed funds rate was near zero. But hey, if you got better credit, you might still be able to score a lower rate. So yeah, at this point, the Fed and those rates, they're playing a game, and we need to stay ahead of the curve.